So we're talking about easy money, about the Fed, central banks. There are a couple of warnings this weekend about the pitfalls of easy money coming from some unexpected places, perhaps you might say. Jon Hilsenrath down in D.C. with that story. John, how are you this morning?
I'm pretty good. You know, I think if we're going to talk about easy money, we need to talk not only about this weekend and what happened at a Fed conference down in Washington, but possibly more importantly, what Ben Bernanke said this morning. You know, he was speaking down here in Washington at a conference of business economists. He gave a very, very grim assessment of the labor market. We've seen a lot of improvement, and he kind of laid out in pretty stark detail why he's suspicious about whether it can continue. You know, what Bernanke gave today was basically an argument for continued easy money policies, which contradicts what the market has been betting lately.
Right, and that kind of runs into this other conference that you were at over the weekend where you had a few central bankers who were warning about the continuation of these easy money policies.
Yeah, so the Fed held a conference, and they had some of the, it's amazing how many trillions of dollars of money was commanded by people in this room. But, you know, he had the heads of the Bank of England, the Bank of Japan, senior people from the European Central Bank and the Fed, obviously, and many other places, trying to take a step back and look at the impacts of their policies. And there were a number of people in the room, including the BOJ Governor, Masaki Shirakawa, and Jean-Claude Trichet, who stepped down from the ECB, or retired from the ECB last year, saying that the central banks need to be real careful and think about the negative consequences of their easy money policies. So it was a warning call by a lot of senior people in the room. Bernanke was there, so was his vice chairman, Janet Yellen. They didn't say much, but they certainly took it all in.
Yeah, you know, it's funny because to me, one of the immediate pitfalls of easy money, when I think about it, Steve, too, is that you look at our own Congress. I mean, rates are so low. They are basically borrowing for nothing. They have almost no incentive to cut spending.
Well, you know, and that's true, and that's the argument that Shirakawa, for instance, was making, and the head of the BIS and a number of people. I'm not sure at this point if I buy that argument because, frankly, I mean, do you think Congress would be acting to rein in the deficit if monetary policy was tighter and we were still in a recession? Of course not. We would probably have even more expansionary monetary policy or fiscal policy right now. So, you know, I think you have to be real careful about taking any of these arguments to extremes. There are downsides to easy money policy, but you always have to look at what the world would look like if the Fed were doing something different. And I think the world would look pretty grim, actually, if the Fed were doing something different right now.
Did anyone talk about exit strategies? Because I know when the Fed and these other central banks started doing these things, that was a big topic. What's the exit strategy going to be? It seems like these central bankers are starting to talk about you talk about the pitfalls. How do you get out? I guess how do you unwind it? That must be a pitfall, right?
No, I mean, in a word, no, they weren't talking about exit strategy. I mean, I think in the Fed's mind, they've got it all worked out. They spent a lot of time in the last couple of years trying to figure out how they would exit these easy money policies when they're ready to do it. It's pretty straightforward. You know, there's all these reserves in the banking system. If the Fed doesn't want those reserves to get lent out and turned into loans that could cause the economy to overheat, they raise the interest rate that they pay on the reserves. They could tighten money very easy. They've got trillions of dollars worth of mortgage-backed securities and treasury bonds in their portfolio. If they want to tighten monetary policy, if they want to raise interest rates, all they got to do is sell this stuff. That's easy. The hard stuff is going to be deciding what to do. I'm sorry, the hard part is going to be deciding when to do it.
When to do it?
Yeah.
All right, let's leave it there. Jon Hilsenrath, thank you very much.